Yo, what's up everybody? It's Vedant and let's talk crypto. Specifically, let's talk about how you can avoid getting absolutely wrecked as a beginner, because let's be real, this market can be brutal. We've all seen the headlines, the crazy gains, people becoming millionaires overnight, but we don't talk enough about the risks involved. Cryptocurrency trading has exploded in popularity and for good reason. The potential returns are unlike anything else out there. But here's the thing, it's not a get-rich-quick scheme. It takes research, strategy, and a whole lot of discipline. Most importantly, you need to understand the mistakes to avoid. That's what we're diving into today. I'm gonna break down the top 5 mistakes I see beginner crypto traders making, mistakes that can cost you serious money. Stick around because by the end of this video, you'll have the knowledge you need to trade smarter and protect your hard-earned cash. All right, let's jump right into the first and arguably the biggest mistake I see beginners making: lack of research. Look, I get it, you see a coin pumping on Twitter, everyone's talking about it, FOMO kicks in and you just want to throw money at it and hope for the best. But here's the truth, that's a recipe for disaster. Cryptocurrency isn't just about buying and selling digital tokens. There's a whole world behind each coin, a technology, a team, a vision. You need to understand what you're investing in. What problem is this project trying to solve? Who are the people behind it? Does it even have real-world utility? This is where doing your due diligence is absolutely crucial. Don't just rely on hype or what some random influencer is shilling. Read the white paper. Yes, I know it can be technical, but push yourself to understand it. Look at the project's roadmap, their goals, their team's experience. Think of it like this. If you were going to buy a house, would you just walk into the first one you saw and sign the papers without even looking around? Of course not. You do your research, get an inspection, understand the value. Crypto is the same way, if not more important, because it's your hard-earned money on the line. Remember, knowledge is power in this space. The more you understand about the projects you're investing in, the better equipped you'll be to make informed decisions and avoid getting wrecked. Don't be lazy, put in the work, and your portfolio will thank you. Alright, let's talk about leverage. This one's a killer, especially for beginners. Leverage is basically borrowing money to amplify your trades. Sounds tempting, right? I mean, who wouldn't want to turn $100 into $10,000 overnight? But here's the problem. Leverage is a double-edged sword. Just as easily as it can multiply your gains, it can obliterate your entire account. Remember, crypto is volatile, like really volatile. Prices can swing wildly in a matter of minutes, and if you're over-leveraged, even a small move against you can wipe you out. I see so many beginners getting lured into these crazy high-leverage trades thinking they're going to get rich quick. But trust me, it rarely ends well. One minute you're up big, feeling like a genius, the next minute your position is liquidated and you're left wondering what just happened. Look, I'm not saying leverage is inherently bad. Used responsibly, it can be a powerful tool. But as a beginner, you need to be extremely cautious. Start small, if you even use it at all. Don't go chasing those insane 100 times leverage trades you see on YouTube. Focus on learning the ropes, understanding risk management, and building a solid foundation. Once you have a good grasp of the market and how leverage works, then you can start experimenting with it more. But until then, keep it simple, keep it safe. Let's talk about emotions, because in the crypto market, your emotions can be your worst enemy. We've all been there. You see the charts going crazy, everyone's talking about the next big pump, and you can't help but get caught up in the hype. FOMO, or the fear of missing out, is a powerful force, and it can lead to some seriously bad decisions. On the flip side, when the market crashes and you see your portfolio bleeding red, it's easy to panic and sell everything at a loss. But here's the thing about emotional trading, it almost always ends badly. When you let your emotions dictate your decisions, you're not thinking rationally, you're not sticking to your strategy, and you're basically gambling, not investing. Successful traders, the ones who consistently make money in this market, understand the importance of keeping their emotions in check. They have a plan, they stick to it, and they don't let the market's ups and downs shake them. They know that FOMO and panic selling are recipes for disaster. So, how do you avoid emotional trading? First, have a clear trading plan and stick to it. Define your entry and exit points, your risk tolerance, and your overall strategy. Second, don't constantly stare at the charts. Obsessively checking prices every 5 seconds will only fuel your anxiety and lead to impulsive decisions. Remember, trading is a marathon, not a sprint. There will be ups and downs, But the key is to stay disciplined, think rationally, and make calculated decisions based on your strategy, not your emotions. Alright, let's talk risk management, because this is where a lot of beginners, frankly, just wing it. They hear stories of people getting rich quick, throwing all their money into the next big coin, and they think, hey, I can do that too. But here's the reality. Ignoring risk management is like playing Russian roulette with your portfolio. You might get lucky a few times, but eventually, it's going to catch up to you. Risk management is all about protecting your capital, minimizing losses, and ensuring that you can stay in the game for the long haul. One of the biggest mistakes I see is putting all your eggs in one basket. Diversification is key. Don't just go all in on one coin, no matter how promising it seems. Spread your investments across different assets, sectors, and projects. Another crucial aspect of risk management is setting stop-loss orders. A stop-loss is basically an automated order that sells your investment if it reaches a certain price, limiting your potential losses. Think of it like an insurance policy for your trades. And finally, never invest more than you can afford to lose. This should go without saying, but you'd be surprised how many people pour their life savings into crypto, only to panic sell at a loss when the market inevitably corrects. Remember, crypto is a high-risk, high-reward game. Don't treat it like a get-rich-quick scheme. Be smart, be strategic, and prioritize risk management to protect your hard-earned money. Let's talk about scams in the crypto space. Scammers are getting more sophisticated. They prey on people's greed and lack of experience. As a beginner, it's easy to fall for promises of guaranteed returns. If it sounds too good to be true, it probably is. Watch out for pump and dump schemes. Scammers inflate coin prices and then dump them. Beware of fake ICOs. Do your research before investing. Verify the project, team, and white paper. Stick to reputable exchanges. Trust your gut and walk away if something feels off. So, there you have it. The top 5 mistakes every beginner crypto trader should avoid. Look, I know it's a lot to take in, but the key takeaway here is this. Cryptocurrency can be a fantastic investment opportunity, but it's not for the faint of heart. It takes research, discipline, and a willingness to learn from your mistakes. By avoiding these common pitfalls, you'll be well on your way to becoming a smarter, more successful trader. If you found this video helpful, hit that like button, subscribe to the channel for more crypto content, and let me know in the comments down below what other topics you'd like me to cover. Until next time, stay safe, trade smart, and keep crushing it.